Hey, welcome back to YT Finance, and this is the channel where I went to business school so you didn't need to, and today we are talking about the best penny stocks to buy now. Now remember, penny stocks are very risky, so always make sure to do your own research to make sure that these stocks and companies align with your own risk management. After that, we'll move on and talk about more singular stocks, but these are going to be more fundamentally solid companies. So we're going to look at 3 supercharged technology stocks to buy right now, which are going to be a little safer than these risky penny stocks, but they also have more upside potential. So for more videos just like this one, go ahead and annihilate that like button, subscribe if you are new, comment down below your thoughts on the companies you're buying, and without further ado, let's jump right into today's stories. Let's start off with an old fan favorite, which is named Skillz Inc., ticker symbol SKLZ, ticker name is Skillz. Skillz essentially is a mobile gaming company to where you can get paid to play video games against other people. Recently, the Skillz stock price has been climbing from their recent lows because they have brought in very impressive earnings in both revenue and earnings for their most recent earnings report. It was so good, in fact, that the CEO even explained that the company is making solid progress in strengthening management and our board of directors with high caliber operators who will enable us to execute against our strategic plan to achieve growth over time as we march to profitability. We continue to innovate on our platform and look forward to reaping the benefits from this work during 2023, end quote. So overall, Skillz wants to take this recent momentum that has been igniting the share price due to their most recent earnings report to keep that going throughout the year of 2023 by creating an even more impressive management team. Analysts are even jumping in on this stock to where financial institutions such as Wedbush reiterated how they believe Skillz is going to outperform other companies in their own space, and they set a $2 price target for this particular company. That means that Skillz has over a 100% growth rate, meaning you could more than double your money for Skillz over the next 12 months. We also see insiders buying this company, meaning that insiders are doubling down on the future of this stock because they believe the future share price is going to be greater than the share price right now. That's why the CEO particularly has bought around 1.5 million shares at an average price between 54 cents and 57 cents. So if you think this company could surge from around 50 cents up to $2, giving you a huge growth runway, then feel free to look into Skillz. Moving right along, let's talk about LifeWallet, ticker symbol LIFW. When it comes to Medicare, Medicaid, commercial, and secondary payer reimbursement recovery companies, LifeWallet is one of the best, and their stock price has recently been rebounding as well. This month, the company announced a significant enhancement to their overall LifeWallet health platform, to where the chief information officer even said, by creating new solutions for healthcare providers at the point of care through innovative technology, we are delivering much-needed resources to eliminate inefficiency and lost dollars while improving patient care through increased accuracy and accessibility. This gives people control over their healthcare data, helping patients, providers, and payers alike. So essentially, they are being very innovative and furthering the overall capabilities of their overall platform. Currently, the LIFW share price trades for 85 cents per share. However, many experts believe this company could surge up to $3. The next company we're going to talk about is MINM Inc., and this is going to be a technology growth company, which has also seen major momentum as of late. And this company creates home networking products. Essentially, they want the devices in your home to be all on the same network to where they can communicate to one another, which is going to present consumers with ease of access and seamless efficiency. The company also operates products and software under the Motorola brand, and recently there has been a massive market opportunity for home networking. For instance, the CEO said at $50 million in annual revenue and a market cap of less than $5 million or 0.1 times sales, there is a measurable opportunity to capture additional value. Essentially, he's saying that the share price is trading so cheap right now and they are bringing in 10 times more revenue than their market cap is worth, that this company is primed for future growth. Right now, they currently trade at 11 cents per share, but that is supposed to increase to 35 cents per share, giving investors a 3 times increase. giving investors the opportunity to potentially triple their money. While shares of MINM stock may be sitting below $1 right now, they are going to go through a reverse stock split, which is going to be a 1-for-25 reverse stock split. And normally reverse stock splits are very bad. So essentially, the company per share is going to increase in their overall share price, and this could build more momentum in the stock price. However, after that, I anticipate short sellers will take advantage of this by trying to lower the company back down to a penny stock. But we're just going to have to wait and see in that overall regard. And this reverse stock split is going to be effective and take place on April 17th. So please be aware of that and the risks that come with a reverse stock split. Again, we could see an initial surge, which stock traders could take advantage of, but after that, it seems that short sellers are going to try to push the stock back down. Next up, let's talk about Stronghold Digital Mining Inc., ticker symbol SDIG, and this is a cryptocurrency mining company. And as cryptocurrency prices start to rise, this is going to be a very strong buying opportunity. What differentiates Stronghold Digital Mining from other mining companies that mine cryptocurrencies such as Bitcoin is that they are environmentally friendly. They are trying to have an environmentally friendly way to mine cryptocurrencies. Normally, other institutions use high amounts of energy that are not the most environmentally efficient or friendly, and they put major strain on the overall grid. However, this company is trying to use a green way to mine these types of assets. And the best part is that following their latest earnings report, the company started to rally because they beat sales by bringing in $23.4 million worth of revenue. This has also caused some professionals to jump in, saying this company could be worth between $1 to $2, even though right now it's only trading at 88 cents per share. So if you believe in cryptocurrencies, feel free to pick up this stock in the meantime. However, always remember that singular risky penny stocks are very risky, extremely risky, so always make sure to do your own research and consult your personal financial advisor. Now let's move on to some of the companies that I think are better buying opportunities because they are more stable, even though they are singular risky growth companies, and I don't allocate more than a 5% allocation to any singular risky growth company. But let's start off with CrowdStrike. CrowdStrike, ticker symbol CRWD, is a cybersecurity company, and they are a market leader in this particular space. As various companies become more technological and move to more of a digital-first front to their business, organizations will need better cybersecurity protection. Because if not, a breach could lead to a damaged reputation, a major loss of customers and consumers, as well as an expensive bill to pay. That's why CrowdStrike has an amazing growth trajectory, and many people believe that CrowdStrike is a leader in this area, and they technically have been for the last 3 consecutive years. They were voted literally number 1 in regards to cybersecurity. Currently, their share price is trading at $137, but if this sounds too expensive for you, make sure your platform has enabled share slices or fractional shares to where you could invest into this company for as little as $1. Experts believe this company is worth at minimum $173 and at maximum $385, so clearly there's a huge amount of upside for this company. This company also has very impressive financials to where their revenues grew by around 48%, and they also converted a lot of this revenue into free cash flow to where they brought in $209 million worth of free cash flow, thus communicating that this company is very impressive in terms of their overall financial stability. Due to these amazing financials, the stock actually surged up around 30% to where it now trades at 14 times sales, and for me personally, I would start nibbling at this company once it drops below 10 times sales, because a 10 times PS ratio is more digestible for an investor like me. However, overall, it does seem cheap according to some investors, but I would say that I would wait for this company to fall in their share price just a little bit, but overall, I do really like the company. Up next, let's talk about DigitalOcean, which is a cloud computing organization, and nearly all industries are adopting cloud computing, meaning that DigitalOcean has a huge market opportunity. Right now, DigitalOcean, ticker symbol DOCN, estimates that they have a $98 billion market opportunity, which is anticipated to surge and balloon up to $195 billion by 2026, meaning that there is a huge growth runway for this overall company. Currently, shares trade for just $36, while experts believe the company is at minimally worth $40 and maximally worth $63 per share over the next 12 months. The company has a very low market cap, coming in at just $4 billion, and they also brought in very impressive revenue growth of 36%. And revenue growth over a 30% CAGR is extremely impressive, especially for growth companies such as DigitalOcean. DigitalOcean still anticipates to grow their revenue by 23% throughout the year of 2023, which is still pretty strong, and they are producing solid free cash flow by converting 22% of their overall revenue into free cash flow, which is very impressive from a financial perspective. Therefore, with a massive market opportunity, loyal customers, and a long growth trajectory, this company should definitely be on a watch list for you, but don't just listen to me, always make sure to do your own research. Lastly, let's talk about another company that I really like and I personally own, which is the Trade Desk. And this is going to be an ad company that makes the majority of their money through advertising. And right now, advertisers aren't satisfied just by placing random ads on websites or videos. Instead, they want to target specific customers and audiences so their money can go further on their overall marketing expenses and investment. Right now, the Trade Desk, ticker symbol TTD, is currently trading for $61. However, I think after the company drops in their share price, it could actually surge and come back and rebound to $90 over the next few years. The Trade Desk is literally competing and outperforming in some instances in terms of growth companies like Meta Platforms and Google regarding their advertising. The Trade Desk can utilize in-house data and customer-specific information to determine how much advertisers should actually bid on certain ads for certain market opportunities. And their technology is so good that 95% of all their customers end up sticking with the Trade Desk for the last 9 years. Meaning that once Trade Desk attracts a customer, they 95% of the time stay with the Trade Desk because they are getting such a great return on their investment from an advertising standpoint. The company also has very strong financials like the other companies on this list, which is why I do like the companies better on this list than I do the penny stock list. The Trade Desk is growing their revenues by 24%, and they also had earnings per share of 14 cents, which is very impressive. Advertising is a massive industry, and the Trade Desk has an enormous growth runway, which I am very intrigued about. Currently, they have a PS ratio, or a price to sales ratio, of 19, which is rather high, and I would say that is the primary drawback for this company. The valuation is rather high, and like I said earlier, I would like to see companies that have a PS ratio or a price to sales ratio below 10. That's when I would start to nibble more at this company. But apart from their expensive valuation, over the long term, this is a solid buying opportunity if you have a long-term growth mindset. But in the meantime, especially with such a volatile market, I would wait for these companies to somewhat pull back, and then I would jump in, because then my money and my investment is going to go farther. I'm going to be able to buy more shares, and once it inevitably rebounds, that's when I'm going to start making profits and value from these investments. So with that being said, I would love for you to comment down below your thoughts on any or all of these companies. Annihilate that like button for more videos just like this one, and I will see you in the next YT video.